welcome to today's video. If you're new to accounting and want to build a strong foundation, you're in the right place. We'll cover the basics, such as what accounting is, its objectives, who uses financial information, and an introduction to the accounting equation and balance sheet. Let's get started. What is accounting? Accounting is the process of identifying, measuring, and communicating financial information to enable users to make informed decisions. First, we identify key financial information like sales, expenses, and assets. Next, we measure these by assigning values such as pricing, inventory, or calculating costs. Then, we communicate this information clearly through reports for managers, investors, and other users. The goal is to help people make informed decisions, whether it's about budgeting, investing, or planning for the future. Now, let's look at financial accounting objectives. Recording financial data. Recording financial transactions in businesses is necessary since it's impossible to remember every detail. Records are kept to track cash, goods bought and sold, and items for use. So, basically, recording financial data is a crucial part of running a business. Without records, it's nearly impossible to keep track of everything. We need to keep track of cash, what we buy and sell, and any items used in the business. For example, a store records cash from sales, it tracks inventory purchases, and it logs expenses like utilities. All of these are recorded as financial data. Classifying and summarizing. Once accounting data is recorded, it must be organized for usefulness by classifying and summarizing. This makes it easier to calculate the entity's profit or loss for a period and to show its resources owned and owed on the closing day. Recording transactions is just the first step. To make financial data useful, we need to organize it. This means classifying and summarizing the information to see the bigger picture. For example, a store sorts its data into categories like sales, inventory, and expenses. Then it adds up the totals. This helps determine whether the store made a profit or a loss and shows what it owns and owes at the end of the period. By organizing financial data, businesses can make better decisions and stay on top of their finances. Communicating information. Financial data allows accountants to evaluate a business's performance, identify its strengths and weaknesses, and determine its values. They then share these findings with owners or other authorized individuals. For example, the accountant looks at sales, inventory, and expenses. They spot high utility costs despite a profit. They present this in a report and a bar graph, and the owner decides to switch to energy-saving nights. Now, let's take a look at who uses financial accounting data and why. Managers use this data for everyday decision making, helping them track the business's progress and status. Owners rely on financial data to assess performance and make well-informed decisions. Potential buyers review the data to evaluate whether they want to buy the business. Potential partners look at the financials to understand the business's health before entering any agreements. Banks assess the data to determine the risk before lending money to the business. Tax inspectors use it to make sure the business is compliant with tax laws. Investors want to see this data to judge potential returns and risks. Lastly, creditors check the financials to evaluate if the business can repay its debts. Feel free to pause the video and review the site on your own. Now, I'd like to point out 2 additional uses of financial information and also highlight the main uses that businesses focus on. Employees who assess job security and suppliers who check if a business can pay them. So which 2 groups of stakeholders are the most important? Owners and creditors. They have the most at stake, and since businesses can't customize reports for everyone, it would be too costly and time-consuming. They focus on providing useful information for these 2 groups. And below is a definition of stakeholder. A stakeholder is anyone who has an interest in a business and is affected by its financial performance. Now, let's talk about the accounting equation. Assets equal liabilities plus capital or equity. Assets are what the business owns, like cash and property. Liabilities are what the business owes, like loans and bills. Capital represents the owner's investment, which could be money, property, or equipment. This equation is the foundation of accounting, and the balance sheet is structured around it. The balance sheet is a financial statement that shows a company's financial position at a specific point in time. Let's look at an example of the accounting equation. On June 1st, 2019, E. Johnson started a business and deposited $40,000 into a bank account specifically for the business. The asset is cash at bank of $40,000 and the capital introduced is $40,000. There are no liabilities at this point. The as at in the balance sheet indicates that the financial position is shown for a specific point in time rather than covering a period like other financial statements. Before we continue, I would like to point out a few things. On your left, you'll see the balance sheet from the previous transaction. On the right, where the arrow is pointing, is the updated balance sheet reflecting the new transaction. Also, pay close attention to the bold words and figures such as market sold $25,000 in this example. These highlight the changes made from the previous balance sheet to the updated one. Purchasing an asset for cash. On June 4, 2016, E. Johnson purchased a market stall for $25,000, paying through an online transfer from the business bank account. Now, let's see how this affects the balance sheet. On the assets, we have market stall, $25,000, and cash at bank, $15,000. The total assets is $40,000. Capital, which is the owner's investment, is still $40,000. Since cash was used to buy the market stall, the total assets remain the same, just in a different form. Purchasing an asset on credit. On June 6, 2016, E. Johnson acquired inventory worth $7,000 on credit from D. Smith. In the previous transaction, June 4th, E. Johnson purchased a market stall for cash, which only changed the format of assets but not the total value. Now, with this new transaction, total assets increased to $47,000 because $7,000 was added to inventory. Liabilities increased to $7,000 because the inventory was purchased on credit. Under liabilities, there will now be accounts payable of $7,000. The brackets indicate a negative amount or an amount to be subtracted. Sale of an asset on credit. On June 8, 2016, E. Johnson sold $600 worth of goods on credit to J. Brown, creating an account receivable. Now, in this transaction on June 8, assets remain at $47,000, but their breakdown changes. Inventory decreases by $600 because goods were sold, but at the same time, accounts receivable increases by $600 since payment is yet to be received. Sale of an asset for cash. On June 13, 2016, goods that cost $350 were sold to A. Turner for the same amount. The payment was made immediately by debit card. Now, in this transaction, on June 13th, E. Johnson sold goods for cash. This increased cash at bank by $350 and reduces inventory by $350. Total assets remain at $47,000, but the mix of assets has changed. Cash at bank increases by $350, inventory decreases by $350. Payment of a liability. On June 15, 2016, Johnson made a $3,000 payment to D. Smith by internet transfer. This transaction affects both assets and liabilities. Changes in the balance sheet. Cash at bank decreases by $3,000. Accounts payable decreases by $3,000. The accounting equation remains balanced because cash and asset decreased by $3,000 and account payable liabilities also decreased by the same amount. Collection of an asset. On June 31, 2016, J. Brown made a part payment of $200 by check for the amount owed. This transaction affects assets but does not impact liabilities or capital. Changes in the balance sheet. Cash at bank increases by $200 and accounts receivable decreases by $200. Total assets remain at $44,000, but their allocation changes. More cash is available, less is owed by the customer. The accounting equation stays balanced because cash increased by $200 and accounts receivable decreased by the same amount. Before we wrap up, here are a few additional insights to keep in mind. The balance sheet is also called the statement of financial position because it shows a company's financial standing at a specific point in time. Assets and liabilities are divided into two categories, current and non-current. Current assets like cash and inventory are expected to be used up or converted into cash within a year. Non-current assets like building and equipment last longer than a year. Similarly, current liabilities such as accounts payable are short-term obligations, while non-current liabilities like long-term loans take more than a year to settle. Also, when you hear about buying or selling on credit, it's sometimes referred to as buying or selling on time. This just means the payment is deferred to a later date instead of being made immediately. That brings us to the end of this video. I hope you found it helpful. Thanks for watching and I'll see you in the next one.